This is what happens when you skip the basics of investing. It might look okay at first, but all it takes is one small mistake and it all comes down. This happens to many beginner investors that jump right in hoping for the best. Because investing without a plan is just like building your financial future on a house of cards. And so this doesn't happen to you. Let me show you step by step how you can start investing successfully from the ground up, so your investment strategy stands strong, not like this. Investing can seem scary and overwhelming at first. It was for me too. Stocks, ETFs, volatility, risk. Ugh. But here's the good news. You don't need to be a financial expert to reach your financial goals. Whether that's retirement or home or simply financial freedom with enough passive income to do whatever the fuck you want. Whatever your financial goals might be, they start with building a strong foundation, one card at a time. Card 1. Do a financial checkup. Before you invest, you need to know where you stand, what's coming in, what's going out, and what's left at the end of the month. Track your income and expenses with a budget app or a simple Excel sheet. You don't need to track every single euro, but aim for a realistic overview and go back 6 or 12 months to eliminate one-time events. Card 2. Build your emergency fund. Life happens. Washing machine breaks, cars need fixing, you might lose your job. Aim for 3 months worth of living expenses parked in a separate, easily accessible savings account. Because the golden rule is that you only invest money you don't need in the short term. Otherwise, you might be forced to sell during a market crash. And that's not fun. You can find the best savings accounts in Europe on our website, currently offering up to 2.8% interest. Link is in the description. Card 3. Set your investment goals. What are you investing for? Retirement or home? Financial freedom? Make them specific, measurable, and personal, because your goals shape everything that comes next, from how long you invest to what you invest in. With your foundation set, let's build the first row of your house, starting with your investment options. You don't need to use every card to build your house, but you should know how they all fit together. Think of this as your investing toolbox. You might not need every tool, but you need to know what's available to build a strategy that works best for you. Card 1 is safe, interest-based products. We already talked about Tagesgeld. It's flexible, your money is available anytime, and the return is, well, okay-ish. Festgeld locks your money away for a set period in exchange for a slightly higher interest, up to 2.9%, with a calculator on our website that is linked below. Both have basically zero risk because 100,000 euro are insured with the local European government. And that's why the return is pretty low as well. So they're best used for your emergency fund or any short-term needs. Also pretty safe are bonds, Anleihen in German. That's card 2. With bonds, you're basically giving a loan to a company or government in exchange for regular interest, called a coupon. You can get a coupon on savings account level, because the German government is probably not gonna default. And that's why the coupon is pretty low. But you can also get a high coupon of over 5% with the French retail company nobody has ever heard of, if they can pay back their debts in 2027. Big if. And this Casino Guichard Parachon, if you're French, your ears probably start bleeding right now, is the perfect example for card 3, stocks. Just look at their stock chart. In 1999, a single stock was worth more than 12,000 euros, and now it's worth 62 cents. That's the nature with the majority of stocks. Most perform a lot worse than the overall market. Investing in single stocks is doable, don't get me wrong, but it takes a lot of homework. So maybe card 4 is better for you. Funds and ETFs. Both are basically baskets of investments, stocks, bonds, whatever, and that spreads out your risk through diversification. Active funds are managed by humans that promise higher returns. which comes with higher fees, because the poor fund manager needs to fill his fridge too. And since hardly anyone can outperform the market anyway, ETFs are managed by computers that have become very popular over the last few years. If you want to try funds or ETFs out yourself, you can buy them with the best investment accounts that you can find in the calculator on our website that is linked below. Card 5 is probably the most popular investment among you guys, real estate. And that's why we've made an entire playlist about real estate. Check it out right here. Buying a property to rent out can give you a steady income. Plus, over time, property prices usually rise. If you bought the right property, of course. What separates real estate from the other investments is that you need quite some capital to get started, so it might not be as beginner friendly. And if you would like to know which investment or investments is best for you, you can book a free meeting with us right here. And card 6 completes the first row, alternative investments. Things like gold, crypto, options, P2P lending, or even solar investments. They might sound exciting, but most come with higher risks or more complexity. So, if you don't fully understand how it works, don't invest in it. Period. Now that you know your options, let's build the second row of your house with step 3, your investment strategy. This is where everything you've defined so far comes together. Card 1. Your strategy starts with your goals and how long you plan to invest. Are you investing for retirement in 30 years or a home in 5? Your goals decide what kind of return you're aiming for, and your time horizon tells you how much risk you can afford. A longer horizon means you can sit out market dips and go for higher return investments like stocks or ETFs. Short horizon, you'll want to play it safe with more stable investments like bonds or savings. Card 2, risk. Now comes the part where you need to be honest with yourself. How much risk do you want to handle? And I'm not talking theory, I'm talking real emotions here. If your portfolio dropped 30% tomorrow, would you panic and sell, or stay cool, calm, collected, and wait it out? I get it. You want the highest return possible. I do too. But higher reward always means higher risk. Your strategy has to match your emotional and financial capacity for risk. Because at the end of the day, you want to sleep at night. Card 3, diversification. This is probably the #1 investing rule there is. Diversification means don't put all your money on one card only. Split your investments across different asset classes, stocks, bonds, real estate, commodities, and diversify across regions, industries, and companies. If one part of your portfolio takes a hit, the other investments can balance it out. And card 4, stick to the strategy. This might be the hardest part because you have to ignore the headlines, eliminate the noise, don't chase the next hype, avoid panic selling. Investing isn't a get-rich-quick scheme, it's long-term wealth building with a plan. And if the plan works, stick to it. But also stay flexible. If your life changes, your financial plan should adapt with it. Because the best strategy is the one that you can actually live with. Your house is almost done. All it needs now is a roof to protect what's underneath. So let's talk about 2 investing mistakes you definitely want to avoid. Card 1. Don't let your emotions get the best of you. It might sound counterintuitive, but investing is 80% mindset and only 20% numbers. Your biggest enemy isn't the market, it's your emotions. Fear and greed cause people to make really bad decisions. They try to time the market, chase guaranteed strategies from some finance bro on social media, They trade too often to hit the jackpot. And then there's the classic, letting losses run and cutting winners too early. I'll just wait until I'm even again. No, that's not a strategy, that's emotion talking. I get it, losses feel bad and you want to get rid of them. But what does logic say? If you hold your losses and sell your winners, guess what your portfolio ends up with? Losers. You have to do the opposite. Cut the losses and let the winners run. And card 2, the biggest mistake is not starting at all. This is where most people fail. They feel overwhelmed or scared, they think they need to be rich or an expert to begin, so they let their money sleep in the bank, while inflation quietly eats it away, month after month, year after year. You don't need to get it perfect, you just need to get started. And you need to avoid mistakes, because mistakes will make your house go. And so your house stands stronger than this one. Book a free meeting with us right here and watch this video now to learn more about passive income. Thanks for watching und bis zum nächsten Mal.